Hi all, welcome to episode 7 of Direct Stock Investing series. Yes, as we can see around the world, it's war and stock markets are crashing across the globe. Indian markets today also it's crashed around I think 400 points. I am shooting it on 4th of March. So most of the stocks, even mid caps, small caps, it's like a broader market sell off in Indian markets and not just Indian markets, European markets, even to some extent US market also falling. So it's panic everywhere and stock is the least investable asset at the moment. That's what we can see because it's a risky asset and people don't want to put their money into a risky asset when it's wartime. And we can also see that gold is picking up again, both gold, silver. So I think the major thing that's happening right now in the markets around the world is complete volatility. There is absolutely no prediction, no direction, and mostly it's in the downward direction as expected when it's wartime. Crude oil price is rising. I think it's crossed $80 per barrel. And as long as Iran and Israel and US and other nations are fighting each other, it's going to be a hard time for all of us. So yeah, it's very uncertain what's gonna happen next. But having said that, if as I continue with my direct stock investing series, I thought anyway today I thought of discussing about the stock selection criteria. So I feel like this is a good time to understand how to pick a stock. Not necessarily you can invest into stocks right now because there is uncertainty, but if you feel like obviously certain stocks are very cheap in this market, and if you can pick some of them and if you have cash to deploy, probably you can consider investing into some of those stocks that are already beaten heavily. So in today's video, let's talk about the stock selection criteria, the strategy to pick a stock for long-term investing. So I have 6 points to discuss, not in any order. All 6 are crucial. So let's dive into it one by one. And the first point is the valuation of a stock. I have discussed about valuation in the previous episodes, and if you see, valuation is the most important aspect when you ask me about picking a stock. Obviously I will talk about other parameters, but why valuation is so important is that the upside of a stock can be greatly determined by the value in which you invest into a company. Say for example, when I say valuation, it's like basically the PE ratio, right? If you are investing into a cheap stock, right? Probably say for example, say for an IT company, if a stock is trading at 10 PE and the potential is huge, say for example the company is heavily investing into AI and all, there is a chance that the stock can outperform. With 10 PE, even if the stock doubles, the PE becomes 20. Still, it is a decent buy, right? I mean, I hope you are understanding that concept of PE ratios. Say, for example, you are investing into a stock that is 10 PE without any change in fundamentals, without any change in net profit or EPS or anything, just by sheer doubling of share price, the PE will expand from 10 to 20. Still at 20 PE, it's a relatively decent buy. Why? 20 PE is also against not a you know uh, highly valued stock. It can go to 30 PE also. See, there are certain companies, IT companies earlier, now it's beaten down because of this volatility, but there were companies it was trading around 40, 50 Ps. So this particular stock, if it goes from 10 PE to 40 PE, that is what we call as PE re-rating, right? considering the potential of the company, investors are ready to pay 40 times the value of the company. So just from 10 PE to 40 PE, the stock gave you 4 times return. That's what it means when the PE is re-rated and the PE is expanded from 10 to 40 without any change in fundamentals. I hope you're understanding, right? So that's the thing. Valuation is the most important aspect when you invest into a stock. So always keep that in mind. When you are planning to invest into a stock, always start with valuation. How much is the PE ratio of this company? Does it has the potential to become a multi-bagger in future? Now, the second point that comes along with this is the market cap of a company. I have already again discussed what is market cap. If you have not watched my previous episodes, please go ahead and watch. I have clearly explained what is market cap and how to calculate the market cap of a company. Say for example, if it's a small company, basically the market cap is very less. When I say small market cap in Indian context, probably less than 1,000 crores of market cap. Those are very small companies, right? And if the market cap is small and the company has huge potential, then that is a good stock to consider, because there is a huge potential for market cap expansion, right? Hence, if you can pick a company with a small market cap, basically a small company with good potential, it can give you a multi-bagger return again. So the second point is market cap. Bigger companies are already reached a saturation point. So probably it will give you 10%, 15% returns, CAGR returns over long term, but not necessarily 30-35%. But small market cap companies with extra potential can give you that sort of returns over long term. That's when my third point comes, which is the sector, right? Which sector the company is into. Some sectors are cyclical. Some sectors are already past their glory. Some are new sectors, say, for example, the AI, EV vehicles, even to some extent, data centers. Those are new sectors, renewable energy. Those are new sectors that are coming along the way, and the companies that have exposure to these sectors can have good run in the future. So if I combine the 3 points, if you are getting a good company within a sector that has good potential, with a small market cap, with a cheap valuation, ideally that is a good company to invest. Is that all? No. There are 3 more other important parameters that I feel like to be considered before investing. So let's talk about the fourth point, which is the management of the company. If all the 3 previous criteria are met, but the management is not capable of delivering, then it's not a good company to invest. Because an incompetent management is always a curse for the company and for the investors. And you also have to check, say, there are a lot of new IPOs happened recently, right? You have to check whether the management had gone through some tough times and came back. They have revived the business. Maybe they had gone through the COVID crisis. If the management had faced a lot of challenges and came out strongly, then you can say that they are competitive. And also the integrity of the management is extremely important, right? The management, the promoters should not be someone who has bad track record, corporate governance. There are a lot of cases, especially in small companies. there are, I mean, even in large companies also, but especially in small companies, the corporate governance is a big issue. The management is not ethical. They are rooting the company fund for personal gains. Those things are extremely dangerous. Those are red flags when you are investing into a company, right? So management is extremely important. An able management, a competitive management is required. Without that, the company has limited potential. Now comes the fifth point, which is debt. Again, if I consolidate the previous 4 points, all four are good, but the company is growing mainly because of high debt. The management is taking more debt for their day-to-day operations, and if the debt is unsustainable, then it's going to be extremely difficult for the company, to maintain that sort of growth for 5 years, 10 years, because always you have to pay the interest to the bank, and it will impact the bottom line, which is the net profit of the company. Sales might be growing, but it because of the debt, margins will be hit badly. There can have some sort of debt, because without taking some risk, without taking some sort of additional money, it's hard to uh, expand the business, but it should be within a limit. What is that limit? That depends on the company, what sort of business that they are doing, whether the debt is a long-term debt or a short-term debt. There are different parameters inside the debt. But basically, what I usually think is that if the company has a cash flow, say for example, if the company has 10 crores of cash in the balance sheet and the debt is less than that, I would say it is still manageable, because even if something goes wrong, the company still can, pay off that debt. So that is something I personally use, but it varies. Uh, Depends on investors to investors. So we talked 5 points, and the last point, the sixth point, is the shareholding pattern of the company. What do you mean by shareholding pattern? To talk about that, I have to talk two things. There are two sorts of companies. One is a company owned by a family, a group of family members. Basically, uh, the day-to-day operations are controlled by a family. Father will be the founder, maybe the son will be the MD, or son will be managing the other businesses, and their son, it's like a family owned business. And the second category is professionally run businesses. So example for family owned business is, say for example, Reliance is right now a family owned entity, right? Dhirubhai Ambani started, Mukesh Ambani is continuing that, and even now his children are into different business, right? Jio, Reliance Retail, all are handled by their children, his children. So Reliance is a family-owned business, but when it comes to L&T or ITC, those are not family-owned business. Those are professionally run companies. Why? Because there are no single promoter. There is a CEO, there is a board who is appointing the CEOs, and the CEOs are running the business. So the difference is that if there is nothing wrong in family owned business or in professionally run business. It's about how you manage. Say for example, for family owned business, if the family has largest shareholding, that means they are the people who are running the company. They have a personal interest to grow the company, right? Because as and when the company grows, their capital also will grow, their shareholding will also grow. It will directly help them, right, to build their net worth. So they have a very personal interest in building that company. Hence, if when I say shareholding pattern, if the family in a family owned business, it's mainly applicable for a family owned company. If the family has the largest shareholding, and they are not selling it at all, and the business is growing, that's a good sign. And also, if they are buying more shares from the secondary market, from the stock market, that means they have very good conviction on their company. That's the reason they are buying, they are increasing their shareholding into their company, right? So whenever you see a company, whenever you see the shareholding pattern, if the promoter share is increasing, that means the promoters have good confidence in the long-term potential of the company. Those are very good companies to invest. But on the other hand, if the promoters are selling, there are two types of selling. One is pledging for short-term capital expenditure. But if they are selling without any reason, that means they don't have the conviction. They are not interested enough in their own company. Hence, it's not a good sign. For me personally, if the promoter is selling too much, then that's not a good sign, and I may not consider investing into such stocks. This is not applicable when it comes to professionally run business, because the shareholding pattern is totally different. Uh, Mutual funds, international funds, uh, varieties of categories of funds will invest into professionally run businesses. So over there, shareholding pattern won't matter that much. I hope all the 6 points are extremely clear. So if you go through one by one, all these are extremely important. And if all of them, it's very hard to find a stock that fulfills all these criteria. But if you find such stocks, always put it into your watch list, keep it in your radar. And if you have money, and if you build the conviction, I hope you can slowly put some portion onto it. Hope it is clear the stock selection criteria. This can be applied onto all sorts of stock. It's sector agnostic. uh, whether you are investing into IT companies, banks, FMCG, whichever it is, whichever sector you are investing into, if you can find stocks that fulfills these criteria, it's always good to jump onto it. So yeah, that's about today's video. uh, Hope you learned something new in this, and if you have any doubts regarding this, feel free to share it in the comment section. And as I said, the stock market is uncertain. Forget about stock market, the world is uncertain. We are living in an uncertain time. It's been uncertain for a while now, I would say. So if you're planning to invest, be extremely careful. Of course, things will get better in the long run, but we always needs to have caution, because the one thing that we all should understand is that capital appreciation is important. At the same time, capital protection is also equally important. So if you are jumping into invest into something, and if you are losing the money, it's not advisable at all, right? Make sure that you are protecting your capital first. Capital appreciation comes later. So yeah, that's about today's video. There are a few more topics that I want to cover in this series, so I will come up with that in the next video. Till then,